afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a quick note that everyone that is registered for today's program will receive a copy by the end of next week. Today, we're excited to welcome back our good friend, Erin Kerrigan, founder and managing director at Kerrigan Advisors. Erin, I know you have a lot to fill us in on. I always loved your theme presentations, so take it away.
Okay, well, thank you very much, and thank you for the opportunity once again to speak to this awesome group. We have certainly lots to talk about today. This is a hot topic as we all look to 2022, which is quickly approaching, and try and identify what the future may hold. I do have some insight, having just completed the Kerrigan Advisors annual dealer survey, which we published, and I can give you a highlight. Things are definitely looking up. Before I get started, for anyone on the line who may not be familiar with our firm, Kerrigan Advisors is the leading sell-side advisor for higher value dealerships and dealership groups nationwide. Our firm does not take listings. Rather, we work on a select number of valuable transactions, actively managing the sale process from beginning to a successful close, including managing the due diligence. We take a very hands-on approach, and our work is not done until our client's sale is complete. For us, it is about quality, not quantity. My team and I are dedicated exclusively on meeting our clients' personal and financial goals throughout the sale process, and are really honored to represent each client in what is often the most financially meaningful deal of their careers. In addition to sell-side advisory, our firm does provide consulting and capital raising services to growing dealership groups seeking a thought partner for their expansion plans. Every Kerrigan Advisors client is a referenceable client, we are very honored to say, including our most recent client, Ken Stevenson, owner and operator of Denver's largest privately owned dealership group, which sold just last week to Asbury Automotive. We are deeply appreciative of the opportunity to work with each client to ensure their exit reflects their legacy in the car business. With that brief commercial, let's turn to the topic at hand. We certainly have lots to talk about. I thought it only appropriate to employ a holiday theme. After all, it is December, and we are once again enjoying the opportunity to finally celebrate in person with family and friends this season. The holiday excitement that I'm seeing around the different parties and what have you that I've been fortunate to attend remind me a great deal of the jubilance around today's buy-sell market, which is on track to hit another record year. Kerrigan Advisors expects 2021 will far surpass 2020's previous record, with at least 350 buy-sells by the end of the year, representing over 600 franchises. As we noted in our second quarter Blue Sky report and on our AIADA webinar in September, many sellers are laser focused on closing before the end of the year due to the threat of a potential increase in capital gains tax. As a result, we expect the fourth quarter to far surpass any previous quarter this year or on record. Our firm, for instance, will represent clients in the sale of 25 dealerships in just the last 30 days of business in 2021. Of course, it will come of no surprise to anyone on the line that the primary driver of today's tremendous activity is our industry's explosive profitability. In the 9 months of 2021, the average dealership earned a jaw-dropping $3 million, up 168% from pre-COVID averages, and remarkably more than double any prior year's full year earnings before COVID. Our industry has simply defied all odds and proven to everyone the resilience of our business model, even in the most challenging of circumstances. Today, most dealers are making more money than they could have ever imagined in a single year. One of the primary drivers of auto retail's stellar performance, of course, is the limited supply of vehicles resulting from the semiconductor chip shortage. In June, the estimated day supply of new vehicles reached a record low of 29 and has remained at that level through the third quarter. Limited supply, of course, is driving up vehicle prices. At present, the industry is benefiting from today's unusual environment of both rising used vehicle prices coupled with very low interest rates and record low borrowing rates. The confluence of these two factors is really enabling customers to buy cars with more equity and greater confidence given the value of their trade-in, which continues to rise as their payments decline. How long this exceptional economic combination lasts is certainly unknown. However, in the near term, it is creating a tremendous tailwind in auto retail. And of course, leading to record gross profits per vehicle. Year to date through September, average new vehicle grosses are up 190% compared to pre-COVID levels, and used vehicle grosses are up an impressive 85%. Now, with no end in sight to the industry's supply constraints, higher gross profits are expected to be a fixture of the industry into 2022 and potentially even longer. I like to say if it takes 60 days to create a habit, our industry will have been operating with limited inventory for as much as 2 years, potentially making lower inventory levels and higher grosses the new normal. Increasingly, OEMs are announcing plans to reduce their day supply of inventory even after chip availability rebounds, as many have recently experienced the economic benefit of undersupplying the market, including lower incentive spending and higher corporate profits. Dealers today are also witnessing the economic advantages of a more efficient business model, including achieving historic revenue per employee and discovering fewer employees can, in fact, produce higher earnings when they are more productive. Much of these productivity gains are expected to last long after inventories rebound. And as Earl Hesterberg, CEO of Group 1, says, we've increased the productivity of our salespeople by 30% pre-COVID versus today. There is absolutely no reason to go backward on that. And many dealers have no plans to return to the low margin business from which we all came. While 5.4% net to sales may be difficult to sustain in the future, the industry is not planning a return to the pre-pandemic averages of just 2.4%. Today's auto retail business model is simply better and one that many would like to see stick post-pandemic. With that backdrop on the industry, I'd like to discuss some key trends in the buy-sell market, starting with the buyers. Kerrigan Advisors finds most dealers today are buyers, not sellers. With the drumbeat of consolidation getting ever louder, dealers increasingly believe size will determine their future success. Many are also focused on expanding their regional market share and diversifying their franchise mix, and few believe the steady state will suffice to succeed in a rapidly evolving auto retail environment. The saying, the more the merrier, certainly applies here. And many are thinking big. Kerrigan Advisors sees a rising pool of dealers who are anxious to put a significant amount of capital to work and acquire dealership groups, not just single franchises. In the first 3 quarters of 21, the number of multi-dealership group transactions was up an impressive 93% from pre-COVID averages, with 79 dealership groups sold. Now, while there have always been buyers for dominant dealerships in growing markets, the buyer pool for smaller and medium-sized dealership groups was often quite thin before COVID, particularly if a major national consolidator was uninterested in the acquisition. But since 2020, the pool of buyers for most groups is now abundant, as more private dealers are financially confident in deploying considerable amounts of capital towards major expansion, both in their existing market and in new markets. And we do not expect that to change in 2022. Particularly as dealers have more and more access to capital, both from their own growing pool of cash and the debt markets because of the deleveraging that has been going on due to the industry's unprecedented profitability. The average dealer's debt to equity ratio declined to just 0.85 at the end of the third quarter, a 32% decline from 2020 and the lowest level on record, meaning dealers have access to and have excess borrowing capacity in a time when lenders are anxious to increase their loans outstanding. Today, dealers have increasing availability to acquisition financing at historically low borrowing rates and attractive terms. And most find themselves in the strongest financial position for acquisitions that they have been in their entire careers. Well, most of the transactions in our market and the acquisitions are completed by private buyers. The primary acquirers in the buy-sell market remain private. However, we are starting to see a significant uptick in transaction activity by the publics. As you can see here, the publics got back into the acquisition game in 2020, and year to date through 2021 through third quarter, the publics as a group have acquired 95 franchises, reversing their pre-COVID contraction trend when they were selling more dealerships than they were acquiring. As you can see in 2019, when they reduced their franchise count by 32. And Wall Street investors are certainly pleased with these companies' ability to grow through accretive acquisitions. The Kerrigan index of the 7 publicly traded auto retailers is up an impressive 256% since the March 2020 lows and has outperformed the S&P 500 by 150% since that time. With the public stock prices on the rise, more acquisitions are accretive to earnings, and thus they are increasing their capital allocation to acquisitions, leading to $2.7 billion in acquisition spending in the first 3 quarters of 21. And this was before all of their mega deals were announced, and many of which have been completed in this fourth quarter, including, of course, Priority One sale to AutoNation, that's Kerrigan Advisors client, Stevenson Automotive and Larry H. Miller's sale to Asbury, RFJ to Sonic, and Prime to Group One. Collectively, these mega deals have an estimated purchase price based on public documents of over $5 billion, resulting in a total spend on acquisitions for 2021 of over $7 billion for the publics, almost 3 times 2020's prior record, making this year undoubtedly the most acquisitive ever for these public companies. Kerrigan Advisors believes 21 is just the start of a significant industry trend where the largest groups, both public and some private, reach to complete mega deals as more become available and the capital markets support major industry consolidation. Okay, now that we've discussed the buyer trends, let's turn to the sellers, many of whom see a window of opportunity to retire with a big payday and maybe some milk and cookies. Like the new vehicle market, demand for dealerships is far exceeding supply, creating a seller's market for most franchises. In fact, the rising tide of industry performance is lifting most boats, resulting in record valuations across the board. The national average for dealerships blue sky value is now over $10 million, up nearly 60% since 19, and real estate values are also at peak levels, resulting in average prices for dealerships purchased, including real estate, of $22 million. Now, for multi-dealership transactions, most of which include at least 3 dealerships, you are looking at a total purchase price with real estate of over $60 million. As I mentioned earlier, the pool of buyers for transactions of this size before the pandemic was relatively small. Dealers who are considering a sale today realize that as valuations rise, these transactions become even more sensitive to financial markets. More of these dealers want to capitalize on today's high values while buyers are flush with cash and have great access to acquisition financing. Many of these sellers realize that timing is everything when it comes to selling their business. Some are also concerned about the increasing pace of consolidation and perhaps a bit worried about missing their window of opportunity to sell, feeling a bit as if they may be entering the beginning state of a game of musical chairs. As a student of history, I have studied the consolidation of our industry and found that, in fact, auto retail has been contracting almost since its inception. This is not a new trend, with the number of dealers reducing almost by half every 40 years. The big question on many people's minds is what will happen in the next 30 or so years when we hit 2050? Will we have 4,000 dealers, 3,000, or as one JP Morgan analyst suggested, 10? This is particularly concerning for many dealership families who are now at that critical juncture of deciding whether the second, third, or in some cases, fourth generation is up for the task of leading their highly valuable family enterprise through the upcoming industry evolution. These dealers are also keenly aware that few family enterprises make it through generational transitions. In fact, according to the Harvard Business Review, just 30% transition to the second generation, 12% to the third, and a measly 3% to the fourth. Even though auto retail has historically defied these statistics, we find COVID-19 has brought forward many more conversations amongst family members about monetizing their dealerships rather than playing these odds. Another reason some dealers are choosing to sell is because of the risks associated with OEM's future plans for their business model. Whether that is attempts to go direct to consumer, sell service upgrades through the cloud, create a build-to-order system, or change the retail business model altogether so that dealers are simply paid a set delivery fee, as has been started in places like Europe. This is the cover of an article in Car Dealer magazine in the UK, in which this former Hyundai boss says, don't worry, this agency model is going to be just great. You should not be afraid. Well, some dealers are definitely a little bit nervous about some of these changes, and these dealers are keenly aware that our industry's ability to succeed despite low volumes in 20 and chip crisis that we just experienced in 21 and we're continuing to experience was driven exclusively by our pricing power. If that's taken away by simply paying dealers a flat fee for each sale through an agency model, the nimble nature of the business model would be significantly curtailed, as would dealers' ability to adjust to markets and remain highly profitable by flexing their pricing power. These suggested business model changes are particularly concerning when considering the real estate demands the OEMs continue to make, resulting in consistently rising rent expense. Kerrigan Advisors does find that image requirements are a common reason dealers decide to sell, and we don't think that's going to change in 2022. Now, another reason that we are seeing more dealers come to market, such as the Larry Miller Group, is concerns about the investments required to compete against rising national players such as Lithia that are developing very extensive digital platforms that will enable them to sell cars nationwide. This slide here is taken directly from Lithia's earnings call, the presentation that they made to investors. It's available to anyone on their website. And you can see that they're really purporting, look, we're going to have this digital platform that can reach the entire country, and we're continuing to build this out. You also see this quote from the CEO of Larry Miller, Steve Starks, in Automotive News, who said, what it came down to is a feeling like we had grown the business about as large as we could without a national footprint and without having an over-the-top digital retail strategy. So we are seeing some groups decide to sell rather than compete with these new, much larger players. Okay, now that we've talked about the buyer and seller trends, let's turn to valuation. Blue sky values in 21 are certainly not what most expected. The question we continue to get is, how do you value blue sky given the industry's eye-popping profits over the last 12 months? What do you apply a blue sky multiple to? Well, first, let's all remember that a business is only worth what a buyer can and will pay and what a seller can and will accept. With that framework in mind, Kerrigan Advisors finds that few sellers will accept a blue sky value based solely on pre-pandemic earnings, while few buyers will accept valuation based solely on current earnings. From a seller's perspective, yesterday's valuations seem ludicrous relative to today's earnings, while from a buyer's perspective, 2021's earnings seem potentially unsustainable. As with all deal making, the answer, of course, lies somewhere in the middle. Kerrigan Advisors finds that in 2021, most transactions were priced based on an average of pre-pandemic earnings and adjusted post-pandemic earnings, adjusting down some of the outsized gross profits that were achieved in the new and used gross profit department, new and used sales department, but largely leaving most of those earnings and averaging them with pre-pandemic. This led to an average blue sky value, as you saw on our prior slide, of $10.3 million based on an average blue sky multiple of 4.7. However, as higher profitability seemingly becomes the new normal, with quarter after quarter of record profits in 2020 and 2021, and as that pre-pandemic period gets smaller and smaller in our rearview mirror, Kerrigan Advisors expects valuations in 2022 to de-emphasize pre-pandemic earnings, with 2019 representing just a third of the earnings estimate instead of a half, as we saw in 21, and buyers and sellers largely coming to an agreed upon earnings price upon which valuations are determined based on an average of 21, 20, and 19 earnings, likely leading to a new average of $11 million for the average blue sky in 2022. That is what we expect will happen as we enter into next year. And the survey results that we just completed for our annual Kerrigan dealer survey certainly echo this expectation. We surveyed over 825 dealers and found that 79% expect earnings to rise over the next 12 months, and most of these dealers, 77%, are seeking to acquire, not sell, creating a unique market in which there are more buyers than sellers and profit expectations are on the rise. One would argue this is the ultimate seller's market. The survey results also reflected the unique environment in which we are, and that 61% of respondents believe the value of their business will increase over the next 12 months, and only 6% expect a decline, despite the fact that 21 was already in record valuation territory. Ultimately, what a buyer is willing to pay is a reflection of their own return on investment parameters and what they believe they can realistically earn after an acquisition. While that is very difficult to predict in today's ever-changing auto retail environment, the averaging of the last 3 years of earnings may be a good proxy for expected future profit margins once inventories do stabilize at some point in the future, creating potentially a new normal of profitability in the range of 3.5% net to sales rather than the pre-pandemic average of 2.4%. Now, one thing that all buyers do need to keep in mind is sellers' current return on equity, or ROE, on their dealerships, which is estimated at over 57% and will be very hard to replicate in today's low-yield investment environment. Few investments provide the level of return afforded dealers in their businesses, particularly on a risk-adjusted basis, which frankly makes it difficult for many of them to sell. We find more sellers are willing to wait and reap the benefits of their incredibly profitable franchise rather than accept any form of discount on their blue sky. Okay, now that I've discussed how to think about blue sky valuation into next year, I'd like to highlight some important valuation drivers and trends to keep an eye on in 2022 and beyond. And the first one is interest rates. There is a clear inverse relationship between interest rates and the value of your business. This is best evidenced when looking at a public company's stock price relative to its bond yields. You can see here that historically, as AutoNation's bond yield goes up, its stock price has declined. This is no different than what we see with private companies. When interest rates rise, acquisition financing gets more expensive and harder to come by, and blue sky values typically decline. In fact, one could argue the most important determiner of your business's value is the interest rate environment in which you sell. With inflation rearing its ugly head and the Fed beginning to taper quantitative easing and potentially raising interest rates, we do expect that we're going to see interest rates rise. And if they do continue to rise, they've already ticked up, this will likely have a negative effect eventually on future blue sky values and how much buyers are willing to pay. In addition to interest rates, another trend to watch is electrification. OEMs have dramatically shifted their investment dollars from the combustion engine to electric vehicles, seemingly in a race to say who can spend more on this new technology at the expense of the old. Whether you like electric vehicles or not, if you follow the dollars, that is where the industry is headed. What is fascinating to us at our firm is that the move to electrification, which undoubtedly will majorly impact our business model, has yet to be priced into blue sky values. Buyers almost never mention it. Now, there are likely two reasons for this. First, consolidators are skeptical as to when electric cars will dominate the industry. And second, they are uncertain exactly how electrification will affect future profits. Once buyers have answers to these two questions, we do expect the shift to electric vehicles to be priced into blue sky, so we are keeping a close eye on OEMs' plans, particularly timing and the impact on dealership earnings. The last and perhaps most interesting trend we are tracking in valuation is what we call the Carbona Effect. Today, Carbona is valued now actually even higher than when this slide was created at $47 billion, more than 4 times Lithia, despite the company's minimal profits and meager sales. The question on many dealers' minds is why? The answer is disruption and revenue growth. Wall Street is enamored by Carbona's demonstrated ability to grow revenue and take share in the 40 million plus used car market, and this is driving up the company's stock price and ultimately enabling it to raise more and more capital, even if it is incurring losses. These investors believe this company will meaningfully disrupt the largest retail industry in the US, autos, and this valuation paradigm based on revenue, not earnings, is beginning to take effect on how dealerships, particularly dealership groups, trade. It's important to remember that evolving industries often are valued by financial markets in different ways than traditional multiple of earnings methodologies. That the way that most companies are valued, legacy companies in particular, in an industry. We saw this during the dot-com era when Wall Street valued eyeballs over earnings. Similarly, Amazon taught investors to be patient as that company took decades to turn a profit, believing that it would someday maybe become the dominant retailer. Investors who backed Amazon were handsomely rewarded, and many of these same investors are now committing capital to our industry and seeking the next Amazon. With that in mind, our public companies are refocusing their efforts to increase revenue both through acquisition and disruptive digital technologies, emphasizing their ability to grow their top line and hoping Carbona's frothy valuation metrics will rub off on them. Looking at our public's valuations based on a percentage of revenue, it isn't surprising to see that the most acquisitive publics trade at the highest percentage of revenue. Now, keep in mind, Carbona is now valued at about 470% of its revenue, so we still have a long way to go, but you see that this is a pretty powerful metric. Interestingly, Lithia is now messaging to Wall Street on its earnings calls that it is pricing acquisitions at 15 to 30% of revenue, which of course is highly accretive since the company trades at 45% of revenue currently. Now that we've discussed valuation trends, let's wrap up this presentation with a review of Kerrigan Advisors' third quarter blue sky multiples. Our report for the third quarter will be published on Thursday, so you're getting a sneak peek at what we'll be publishing. As I already discussed, we find that most deals in 2021 were priced by applying our blue sky multiples to an average of pre- and post-pandemic earnings. However, in 2022, we do expect transactions will be priced more on a 3-year average of 21, 20, and 19's earnings. Now, I always like to say that there is more art than science in value and dealership. In fact, we often see transactions that trade at multiples several times higher and several times lower than those we publish in our report. The reason for this is usually comes down to these 7 drivers here that we detail in our report. But I'm going to point out the most influential one today, and we find that's number 2, buyer demand. And that really is buyer demand for certain markets. The demand today for instance, states like Florida and Texas is off the charts. And as a result, we often see dealerships and dealership groups in those markets trade many times higher in multiple than those we publish in our report. It's location, location, location. For the third quarter of 21, Kerrigan Advisors made 4 positive adjustments to our blue sky multiples. Specifically, we increased the blue sky multiples for Toyota, Hyundai, Kia, and Nissan, all imports, I'd like to point out. These adjustments were informed by our current client engagements, our industry research, and the results of our annual Kerrigan dealer survey. This year's dealer survey highlighted the rising value of Toyota franchises. The majority of dealers surveyed expect this franchise to increase in value 55%, the highest that we've ever seen for any franchise. 55% of the dealers expect that the value of the Toyota franchise will rise. And these results are consistent with our recent experience selling multiple Toyota franchises. So we do think it is quite accurate. As a result, we have increased Toyota's multiple, and we do also think this is indicative of Toyota's really supportive partnership with its dealer network, especially during a time of so much change being projected into the industry. Toyota dealers and Toyota investors feel confident that Toyota will ensure that it's a win-win solution for both Toyota and its dealers as these changes evolve in our industry, whether that's digitalization or electrification. Perhaps the most notable change, though, in this year's survey was the impressive improvement of Hyundai and Kia, which saw over a 23 percentage point increase in the number of dealers who project these franchises will increase in value. With these improvements, Hyundai and Kia became the 2nd and 3rd highest ranked franchises by dealers in terms of expectation for increased valuation, leapfrogging last year's survey results, and specifically leapfrogging Subaru, Porsche, Honda, Mercedes-Benz, and Lexus. Very impressive. The other change we made, of course, is Nissan, as I already mentioned, and Nissan saw a significant improvement also in this year's survey, with 22% of dealers surveyed expecting the franchise to increase in value compared to just 8% last year. That's a 14 percentage point improvement and one of the biggest in the survey. We do expect that Nissan will continue to see improvements as the dealer profitability for those franchises continues to improve quite dramatically as compared to 2020. For the first time, as it relates to luxury franchises, our survey results were not as great for luxury franchises because none of these franchises made it to the top 5 of franchises expected to increase in value. And that was the first time we had seen that. We believe this may be due to the rising competition from Tesla, which sold nearly as many luxury vehicles as the top luxury OEMs in the first 3 quarters of 21. The Tesla threat, coupled with potential changes to the luxury auto retail business model and required capital expenditures to accommodate electrification, including high-speed charging and battery storage, may be the reason that top luxury franchises underperformed in this year's survey. That being said, Lexus was the top performer and continues to benefit from Toyota's partnership business model with its dealers. And we did put a positive outlook on the Lexus franchise as a result. Before I close up this workshop, I do want to highlight a trend that we are going to discuss in this upcoming report, and it's well documented in the report, so I won't go into the full trend, but I want to give you a highlight, and that is the growing difference in valuation methodology for a large dealership group versus a single franchise. Ultimately, we find that most dealers who own large groups hope to sell in a single sizable transaction rather than multiple sales. While individual franchise multiples that make up a group still certainly inform a group's blended blue sky multiple, the premium or discount applied is often determined by the entire group's operation rather than each individual dealership's performance. In other words, a large group valuation are not necessarily based on the sum of the parts and are rather determined by the performance of the entire enterprise. This is certainly an important consideration for those who are considering a sale of a group in today's market, and also an important consideration for those that are growing their groups to make sure that when you are acquiring dealerships, you are making acquisitions that increase the value of your group versus potentially detract from the value of your group. In closing, thank you, of course, for your time. The buy-sell market today is certainly a December to remember, as many dealers seek to complete their transactions before year end. I recommend that we all take advantage of some downtime over the holidays as we approach this year end and this holiday season, because we believe at Kerrigan Advisors that 2022 will be even more active than 2021 based on all of the data that I just presented to you. And I am happy always to answer any questions directly. You're welcome to reach out to me. All of our conversations with dealers are highly confidential. But most importantly, I want to wish you all a very happy holiday and a joyous new year. Thank you, AIADA, as always, for the opportunity to present to your members.
Thank you, Erin, so much for speaking with us today. We always value your perspective and love having you on. Again, you will all be receiving a copy of this webinar by the end of next week. Join us back here on Thursday, yes, 2 days from now, Thursday, December 16th at 2 p.m. Eastern, as Cox Senior Economist Charlie Chesbrough talks to the 2022 market forecast. It's our last webinar of 2021, so make sure to register. For more information about AIADA, visit aiada.org. Thanks for joining us, everyone, and have a great day.